to the Jumpstart Health Investors webinar. I have David Panton here from Navigation Partners. We are going to talk about SPACs, special purpose acquisition companies. Today, I think people, probably researched a little bit in preparation to coming on, but SPACs are not a new structure, but they're growing incredibly quickly. And there's a lot of healthcare aspects of this that I'm interested in, and a lot of my audience is interested in from a health investor point of view. David is really an expert in all things SPAC, including healthcare SPACs, but also more broadly. So before we're going to jump in and have him give us a little background and then have some Q&A. But before I do that, just some quick kind of housekeeping notes. We will have probably 15 to 30 minutes of David and I sort of talking through things to try to give people a basic foundation, but then we're going to try to save time for questions at the end. So you won't be able to speak your questions, but please text them or use the Q&A button to log them in. And if I see an opportunity to weave them into the discussion, I'll do so. Otherwise, we'll come to them sort of towards the end. And so David, thanks for doing this. Really appreciate it.
Glad to be here.
As we start off, maybe just give a quick little bit about your background. How did you come to be in this position now?
Sure, thanks a lot. So I'm originally from Jamaica. Went to school in the States, undergrad at Princeton. I always wanted to be a lawyer until I got to law school. Went to law school at Harvard, and then ended up doing a PhD in business at Oxford University. I went straight into investment banking at Morgan Stanley in New York, and then I went back to Jamaica to start a private equity firm. Wanted to get into the private equity industry. I used to tell people that I ran the largest private equity firm in the Caribbean, which was true, but we were also the only private equity firm in the Caribbean at the time, so we were the largest and the smallest. I sold that in 2003, and I moved to Atlanta, Georgia, where I am now. And I joined a private equity firm called Mellon Ventures, which was the private equity arm of Mellon.
Yeah, so I used to know Max Chi. I don't know if you were there with Max.
I worked very closely with Max. He's a great guy. I like Max a lot. And he's now in New York, doing very well. And so I joined Mellon in 2004. And 2 years later, I bought the firm with my partners. Larry Mock was actually the founder of Mellon Ventures. He's been one of my mentors, and now he's my partner. And so we renamed the firm Navigation Capital Partners in 2006.
Wow, small world. I had no idea that this was going to come back around. Yeah,
indeed. And so we were backed by Goldman Sachs. Goldman Sachs invested just under $500 million in our firm. And we've done just under 50 transactions, primarily in the service industries across the spectrum. And we have our strategy basically historically has been growing companies, taking companies that are sort of sub 100 million in enterprise value and growing them to over $300, $400, $500 million. We've sold companies to firms like Dell and Blackstone, private equity firms. And then in 2017, we decided to get into the SPAC business. And we partnered with two entrepreneurs and operators, a gentleman by the name of Daryl Mays and a gentleman by the name of Bob Willis, who are now my partners. And we did our first SPAC, which was a $310 million SPAC called Pensari Acquisition Corp. We de-SPAC'd actually.
You were the sponsor.
We were the sponsor, that's correct. And we were focused on the telecommunications space. Daryl's background is in telecommunications. He worked at AT&T, Palm, Motorola, Ericsson, had become an entrepreneur, had built a very successful company to about 80 million in revenues, sold it to a publicly traded company called Malstech, and they grew quite substantially. That business, which Daryl ran for 8 years, he did an 8-year earnout. I'm sure you've never heard of an 8-year earnout. But over the 8 year, I was against the earnout, right? But I was wrong and he was right, because over the next 8 years, the company grew from 80 million to well over $1 billion in revenues. And today that business within Malstech is a $2.5 billion revenue business. And so he'd done extremely well. He understood the power of the public markets, because Malstech's market cap went from under $1 billion to over $5 billion. So Malstech invested in our SPAC as a co-sponsor with us. Focused on the TMT space. We de-SPAC'd is what it's called in April of this year. So probably the worst month for deals being closed. We were able to get it closed. And we bought a company called Computex Technology Solutions. And then we renamed, or SPAC, which is the way SPACs work, I can talk about that in a second, as AVCT. And so we're listed on NASDAQ as a regular way public company, AVCT. We subsequently announced another acquisition, which is public, called Candy Communications, which was a division of a publicly traded company called Ribbon Communications. And most recently, we announced a new CEO for the company. So Daryl had been acting as CEO of the company. He's now executive vice chairman. And we have a new CEO, Xavier Williams from AT&T. Xavier is just a rock star. We have very good relationships with AT&T. AT&T is actually Candy Communications' largest client. So it's all coming together, and we're focused on the telecom space.
Okay, so you had that experience in the telecom space, sort of forming a SPAC and then de-SPACing, which is the process of using the funds to buy something. And then you transitioned now into doing it more, helping others more. Is that right?
That's correct. So we decided that SPACs were the future, and we like SPACs. So we set up a SPAC operations group within Navigation Capital Partners, exclusively focused on SPACs. And we have a relationship. We're based in Atlanta, Georgia, as I said, and we have a relationship with Jeffrey Sprecher, who is the chairman and CEO and co-founder of a company called ICE, which you may have heard of. ICE is a company which Jeff Sprecher bought in 2003 for $2 million and grew it over that time period. And today it has a market cap of $70 billion. So he's done a phenomenal job.
The trading platform, right? Or market maybe. Or
it is basically a digital services company is the way to think about it, but they focus on exchanges. And so they're listed on the New York Stock Exchange, and not only are they listed on the New York Stock Exchange, but they own the New York Stock Exchange. And so the New York Stock Exchange had not listed any SPACs up until as recently as May of 2017. And in that year, they listed their first SPAC. And since May and today, so just over basically call it 3.5 years, they have listed over 70 SPACs. And NASDAQ used to be the #1 exchange for listings. And this year, 2020, I believe the NYSE has listed more SPACs, certainly by volume, than NASDAQ. So now they've gone sort of full throttle. And our other partner at Navigation, which is Goldman Sachs, they also did an about turn on SPACs. So up until about 2016, they hadn't done anything related to SPACs, wouldn't do anything with SPACs, wouldn't underwrite SPACs, wouldn't sell to SPACs, wouldn't merge with SPACs.
Yeah, it used to be kind of a looked down upon section of finance.
It was, but that's now changed quite a bit. And so now Goldman Sachs has done a complete about face. And now not only have they sponsored a SPAC, they've sponsored 2 SPACs. So there was GS Acquisition Corp. 1, effectively, where they backed a CEO named David Cody, who bought a company called Vertiv, and they raised $700 million. And they have GS Acquisition Corp. 2, another SPAC, where they raised $750 million, which is still in market today. And now Goldman Sachs has a whole SPAC department, and they have now become, this year, if not #1, certainly within the top 3 of SPAC underwriters in terms of the amount of money that they've raised and the number of SPACs that they've underwritten. And in fact,
So I want to back up, because I think a lot of the audience needs to take 2 steps back. So explain kind of how it works for I always picture my mom about this. Like, how would my mom understand how a SPAC functions? And then, my audience is much smarter than my mom, except that she's probably in the audience.
What's your mother's name?
A regular person think about what a SPAC is or how to approach it.
Sure. What's your mother's name?
Kathy.
Kathy. So let's say I'm talking to Kathy. Kathy, here's what a SPAC is. So let's start with the definition. The definition of a SPAC is a special purpose acquisition company. So that's the definition.
Yeah.
So the last word, the C, stands for company. So it's a company. And that company, the first 2 words are special purpose. That company has a special purpose. And what is that special purpose? That special purpose is to acquire another company. So Kathy, here's what happens. An individual or group of individuals get together and they say, we would like to buy a company. It's fairly clear. and they
like
want.
In your case, you were looking for a telecom company.
In our case, and so many of those individuals have an industry. So we could say we want to buy a healthcare company. That's right.
Yeah, right.
So let's use the healthcare space. We want to buy a healthcare company, but we need capital to buy that company. That makes sense. So we decide that we are going to do an IPO, which stands for an initial public offering. We're going to take public a entity that actually has no assets, is not an operating company. All it has is a strategy, which is to invest in healthcare companies or to buy a healthcare company. And it has a team, and a team that hopefully has an experience in healthcare. So all SPACs should have people who provide capital, who have a strategy, and who have a team.
Yeah, and then hopefully that team and strategy are pretty darn good.
And hopefully they're good, and that will depend. So then you go to the market, you go to institutional investors. You ask a bank, an investment bank, to underwrite the initial public offering, the IPO. And that bank—
When you say Goldman is leading or close to leading, that's what you mean, that they are underwriting many of these.
They're underwriting many SPACs. There are many other investment banks which do it. So Goldman Sachs, Morgan Stanley, Citigroup is very big in this space. Credit Suisse is very big in this space. Deutsche Bank is big in this space. And then there's smaller banks which are specialists in this space, like Maxim Group, Early Bird Capital, which was our underwriter on our first SPAC, and several others. Yeah. So investment bank—
I think of Early Bird as one of the first ones.
Well, Early Bird invented the SPAC product.
Yeah, so more legitimate, make it more
David Nussbaum was the chairman of Early Bird, and he invented the SPAC product effectively in 1993. So SPACs have been around since 1993.
Okay. Yeah.
And so the way they work is an underwriter, an investment bank, goes to institutional investors and asks them to invest cash into not shares, but units. Now, these units include two things, typically. One is a share, and the other is a warrant. And a warrant is a right to buy a share in the future. And that warrant, which is part of the unit, is typically a full warrant, two-thirds of a warrant, or 3/4 of a warrant, a fraction, half of a warrant, a third of a warrant. So some fraction of a warrant in the future.
It's deal by deal. There's different—
Deal by deal. So some SPACs have units with all of them have one share, and then within the unit, and then it's a fraction of a warrant or a full warrant. Okay. So the investor who participates in that unit invests— almost all SPACs go public at $10 per unit. So the investor per unit pays $10. By the way, that didn't used to be the case. It used to be that the price would vary, like with traditional IPOs. One of the changes that has made SPACs more popular is that they made it effectively a fixed price. You don't have to do 10, but everyone does it at 10 for the most part.
It makes it easier to keep up with.
Precisely, and it's easier to benchmark across SPACs, etc. Yeah. So an investor says, I will buy a unit in a SPAC. And what are they buying? They're backing the management team, they're backing the strategy, they're backing the industry, but they're also getting a unique feature, which is very important to understand for SPACs, which makes it unique than any other investment product that I know of. That unit that they receive, which has shares and has warrants, and sometimes they also have something called rights, which is also a right to buy shares in the future. But when they invest in that, they have a right to get their $10 investment back. Now, that's a very unusual feature. I haven't seen it. If you've seen it in any other product, very unusual.
It's a huge advantage or huge
advantage for the investor.
Because otherwise it looks before you know that, it looks quite risky.
Correct. I'm going to invest $10 because you don't know what the person is going to invest in. And if they invest in something terrible, then you're like, why would I do that?
Right. But if I get the right to take my money back after I see the show.
After you see the show, that's exactly right. It's a completely different deal.
Yeah.
And so what happens is that IPO, which raises the units, and let's assume in this case, just to give it a little put a little more flesh on the bones. Let's suppose I was the sponsor and I spend $5 million to do the IPO.
When you say you're the sponsor, it's your team and your strategy.
It's my team, my strategy. I want to invest in healthcare, right? Yeah. You and I are doing it. We are sponsors together. We are gonna raise a healthcare focused SPAC.
Yeah. Okay.
And we are gonna raise $100 million.
Okay.
To raise $100 million cost about $5 million. And
Yeah,
most of that 5 million,
banks, all the different things.
most of the 5 million goes to the underwriter. I
Yeah.
joke all the time that, one fundamental rule of Wall Street is no matter what happens in the world and in the economy, Wall Street bankers will always make money, which is true. So no matter what happens with this, they get paid upfront. Now, part of it is that there is a fee that's owed to them when they do a deal. So it's a split fee, and that's another change that has made SPACs better. It used to be that they could get all the money up front. Now they only get some of the money up front. But most of that 5 million goes to the banks. Some of it goes to lawyers. Lawyers always get paid as well. And the rest of it really is to fund the search for a company. So let's say we spend the 5 million to our underwriters, to our lawyers. We've raised.
We have $100 million sitting there, but we can't use that just in like flying around or meeting people.
We can use none of that 100 million. 100% of that 100 million has to go into a trust account, a third-party managed trust account, managed by someone like, in our case, we used Wilmington Trust. So we raised, in our case, 300 million. We gave all 300 million to Wilmington Trust. And that third party has to manage, let's say, our $100 million healthcare SPAC. Let's call it the V&D SPAC. So we have V&D SPAC. All SPACs have the names at the end of it, Acquisition Corp. So the name of our SPAC would be V&D Acquisition Corp. And we raise $100 million. So we've paid 5 million, we have 100 million, all 100 million goes into a trust account.
Right, and that's important because that gives people confidence that they can actually get their money back.
Correct. Correct. And there has never been, this is important, there's never been a circumstance in which investors have not gotten their money back from a trust account. Okay. So that's very important to understand. You will always have your right to get that money back. And it's always, so far anyway, it's always been safe. And there's a lot of rules around third-party management.
Well, Wilmington Trust and all the trust companies, that's their job.
That's their job. That's right. They can't afford to not make sure that money gets back. Now, it's very important to point out that that trust manager has to invest that money in treasuries. So they can't invest in speculative securities. They can only invest in very safe government securities. Not a very high returning, but at least you get a treasury return. Yeah. And then the sponsor now has
cash on the balance sheet now. It's not that dissimilar from the return I'm getting today.
That's exactly right, which is why I tell people, I can't give investment advice, but I tell people all the time that SPACs are one of the best investments you could ever make. Because if you invest in a SPAC IPOs, to be clear, if you invest in a SPAC IPO, you get a treasury return. Yeah. It's important to understand the sponsor has a time period in which to find a company. It's usually 24 months. So IPO on day one, so V&D Healthcare Acquisition Corp. We have $100 million. We have 2 years to find a company to buy. Yeah. And typically you only buy one company. You can buy two companies. You could even buy more than two. There's been one SPAC, a SPAC called JHI Technology, which bought 6 companies at the same time. But I would not recommend that to anyone. I think you should stick with 1, 2 maximum, if there are 2 that make sense. And so you have 24 months, typically 2 years, in which to buy that company or merge with a company. You don't have to buy it. And that process is called a business combination. So think of it, we do an IPO first, Kathy, and then 2 years to find a company that we're going to merge with or buy. And when we merge or buy that company, it's called a business combination. Yeah. So now you and I have found
a recap to make sure I'm following.
Sure.
You and I have to spend our own money.
Yes.
Let's say $5 million.
Correct.
To pay for all the fees and then also fund our 2 years of work going around trying to find this.
Correct.
Thing to merge or buy.
Correct.
The investor gets almost like a free option.
The investor has a free option. In fact, it's better than a free option. Here's what happens for the investor. We as the sponsor, V&D, have 2 years to find a company. When we find the company, we have to bring it back to our investors. We have to announce it. Yeah. And we have to say to the investors, you have to vote on this deal. Now, the good news is, it used to be in the past that the vote was dependent on whether or not you took your money back. Right?
Yeah, kind of linked together.
They were linked. Today, that rule has changed. They're now delinked. So you now can take your money back whether or not you vote yes on a transaction. So since that rule changed in 2015, 100% of SPAC transactions which have been announced, those business combinations, have been approved by shareholders, right? In the past, that wasn't the case. No, it's 100% because everyone votes yes.
I can approve it, and then I still can get my money back.
And you can still get your money back. That's right. So now, we as the sponsors, we've found a deal, we've negotiated a deal with some private company, and SPACs almost always by private companies, not public companies, because we're taking a private company public. They're doing effectively a reverse merger. And now at the end of that process, we have to take it to our investors. Investors vote on it, but then investors have a right, having looked at the company, having looked at all the financial information, we have to give them all the financial information. There's a very detailed investor presentation that we give the investors. They can then say, you know what, I like the company and I'm gonna keep my $10 in trust and I'm gonna let it roll into that company. Or they could say, you know something, whether or not they like it, they could say, just give me my money back. I want my $10 plus I want my interest on treasuries, which they get. Plus, and this is very important, they get to keep the warrants. So the warrants trade separately from the shares in the units. So if they're going to take their money back, they have to give back the share so that someone else can get it, right? But they get to keep their warrants. So to your point about a free option, think about this investment. You invest $10 in a SPAC IPO in the units. The warrants trade separately from the shares.
Yeah, and they're not worth nothing. I mean, there's value there.
They typically trade at around 50 cents, some slightly higher, some lower. You could sell your warrants for 50 cents.
Yeah.
So you've just made 50 cents on a $10 investment. There's a 5% return. So you've just made a 5% return. Yeah. You then have a right to get your $10 back and you get a treasury rate. And let's say the treasury rate is 10 cents. So that's a 1 cent return. So 50 cents plus 10 cents is 60 cents. 60 on your $10 investment is a 6% return. You now did a investment as an investor in a SPAC IPO where you got a 6% return, risk free.
And that's then right. Can I, like, let's say I buy 10 units, can I roll half and take half back?
Absolutely, absolutely. You can roll some, you can keep them, you can do all sorts of things. And here's what else a lot of people do. So here's a little bit, let me lift the curtain a little bit on SPACs and the SPAC market, which has exploded, to your point, in the past year. The typical investors in SPAC IPOs are hedge funds. So hedge funds are the primary investor for this reason. A SPAC IPO is not your traditional IPO. We're not looking at earnings or EBITDA multiples.
It's purely financial.
This is a financial instrument. That is all that that person is investing in. But it's a great financial instrument. And so what the hedge funds do, because it's, and then, so that's exactly right. So that's what I was going to say. It gets even better for them because they can leverage it. So that's 6% return, which I just 50 cents on the warrant and 1 cent on the 10 cents, sorry, on the treasuries. If they were to leverage their investment, so let's say they did 50-50, okay, and let's ignore the cost of debt for a second. They've now doubled their return to 12%. And where else can you get a 12% risk-free return?
Yeah. And so then they have the option of, if they do 50% leverage, they could roll 50%, and if they like the concept, the company that's bought,
that's right,
and pay off their debt. Or they could take all their money back and do another SPAC.
Although if you're leveraged, you probably want to take all your money back. But anyway, here's what happens. There is actually a third component of an advantage for the investor. So think about the elements for an investor in a SPAC IPO. You have a right to get your money back. It doesn't exist in any other security. You get a treasury return, which is decent. You get the warrants, which is really nice, and which you can sell because they trade separately. And you have an option that if the stock does well because the deal that has been announced is a good deal, then you get the benefit of that increase. So on the day, remember, we have to announce the deal. Once we've announced the deal, the market gets to look at that company and say, that's a great deal.
Yeah.
So let me give you an example. Draftkings is a company you've probably heard of. Yeah. It's one of the leading online gaming platforms in America. They actually have a license, I believe, in New Jersey to provide online gaming. And they have relationships with the NBA and I believe with the NFL. So that's a company which has about 300 million in revenues. And they were a private company. There was a SPAC called Diamond Acquisition Corp, which would raise $400 million. So they spent, basically $20 million to raise the $400 million, the sponsors. They then said to the owners of Draftkings, we'd like to do a business combination with you. They agreed. They actually did do two companies at that time. So Draftkings actually merged with another technology company called SB Technology, whose largest shareholder is a guy named Shalom McKenzie. You probably never heard of his name, but he just became the most recent entrant on the Forbes list of billionaires because Shalom actually took some money out of the deal. So some of that 400 million went to Shalom and some of his other shareholders in SB Technology, which merged with Draftkings. They announced the deal in December of last year, December 2019. They did that vote, and the stock price increased above the $10 that was in trust. So it went up to, I believe it went as high as $13. So if you had invested 10, you just got $3. Right.
So then
so that's a 30% return.
So then everyone takes the stock.
Correct. So now you have a right to take it back, or you can sell your stock. And so a lot of those people decided, no one decided to take their money back. Everyone decided to either stay in the deal or sell. And if you decided at that time,
you're not locked up.
You're not locked up. There's no lockup if you're an investor in an IPO. You could, at that time, you can say, I'm going to sell at $13. And you'd have made, and investors in Draftkings with no risk, literally made, on an unlevered basis, almost a 50% return. Okay, now, that company closed the transaction because you got to close it. They closed the transaction in April of this year, again, in the middle of the pandemic.
So there's a period of time there where the deal's announcement, and then closed. The market immediately is it's fluid, so it's moving all the time.
The market will tell you whether it's a good deal or a bad deal very quickly.
Right, but it's not closed yet, so you have to get it to the finish line and closed.
Correct. Although if you're the investor and the stock price goes up, you could sell it before the closing. Right. So if people like just the announcement, you could say, great, I'll sell right away. So it's not so bad for the investor. And just to tell you what happened, that deal was a $3 billion transaction. So a $400 million SPAC bought a $3 billion company, which was Draftkings and SB Technology. It closed in April. And between April and today, we're now in November, the market cap has grown from 3 billion to just over $15 billion. And actually went as high as 20. But let's use 15 billion. So literally in 6-7 months, they've had a 5x increase in the valuation. Now, why is that? Is it because the company has outperformed 5 times? No. In fact, Draftkings is losing money as a factual matter. And has revenues of around $300 million. So as a multiple of revenues, a very highly valued company. But here's one of the reasons why the valuation has gone up, which is one of the reasons we like SPACs, which is that public markets, there has been a significant decrease in the number of public companies. So in 1996, which was sort of the peak of public companies, there were about 8,000 publicly traded companies in America. That number has fallen in half to less than 4,000 today. So we have half as many public companies today as we did in 1996. And over that same period of time, the amount of money going into the public markets has grown from around 7 trillion to around 35 trillion. So it's grown 5 times. So there's been a 5-fold increase in interest in public markets, chasing half as many stocks. And so this supply-demand imbalance has created a huge demand by institutional investors, the Fidelities, the BlackRocks, the Wellington Capital.
By their policy or by their legal documents, they can't buy things that aren't public.
Many of them can't. By the way, many of them can't even invest in a SPAC.
Yeah.
But because a SPAC is just effectively a blind pool. Right. But what they can invest in is that business combination. So when Draftkings left being a private company and became a public company through a SPAC vehicle, they could now invest in Draftkings.
Yeah.
And so that demand is what is driving a lot of the increase in the value. And that's one of the things we like. Now, you ask what is happening in the markets. And let me just complete the swing very quickly on Jeff Sprecher and NYSE. He owns the NYSE. He did his first deal. So we sat down with Jeff Sprecher and his team at the NYSE, and we said, let us find ways in which we can take companies public on the NYSE. And so we've been through the SPAC process. We understand, we know how to build companies, find companies, buy companies. Let us use all that we learned going through the SPAC process and come up with a methodology and a process that will make it easier, cheaper, quicker, more efficient, and more likely to result in a very good outcome for people who want to do SPACs. That we
So
can
sort of in partnership with NYSE and Goldman, you've worked on this framework, or how you make it easy to do.
That's exactly right. So we have worked primarily with the NYSE on this framework. And what we've done is we have, in one of our meetings with the president of the NYSE, Stacey Cunningham, she said, so what you're doing here is a SPAC in the box. And we said, that's exactly right. And we like that name. So we've trademarked that name, SPAC in the box. And so what we do at Navigation Capital Partners is we provide a SPAC in the box, which is a methodology, processes, an approach, which makes the SPAC process easier, simpler, quicker, et cetera. We have a pipeline of SPACs that we're bringing to market to facilitate that using our SPAC in the box approach.
Yeah. Now, one of the things I want to touch on, because I think it'll be important as we go into your SPAC in the boxes, as a sponsor, like V&D, we're doing this, and I understand it's a great deal for the investors. We've gone through that. It makes me a little nervous as a sponsor. Like, I'm going to commit to buy this company for $100 million. What if a third of my investors take their money back?
Or 50% or 100%.
Yeah, I think you've designed a backstop for that, or like there is a backstop for that. So let's talk about how that works.
Let's talk about that.
Yeah.
So there are two risks that sponsors face, two big issues. One issue is that we don't find a deal in 2 years.
Right.
Now, in my mind, if you are an investor and you know how to,
you've got a bunch of incentive to go find a deal.
You have a lot of incentives to find a deal. If you don't find a deal, however, and there are reasons why people can't find a deal, or you find a deal and it doesn't go through, you can ask for an extension, which people have done. But if you don't do a deal and you don't get the extensions, then you have to return all of the money to their investors. 100 million goes back in our V&D Healthcare Acquisition Corp, and we lose our $5 million.
Yeah, we lose our expense.
So we are at risk capital, and not only do we lose it, that's one risk if we can't find a deal. But let's assume we find a deal, and the good news there is that it used to be that in the past, 25% of SPACs failed, meaning they didn't close for whatever reason, and the sponsors lost all their money. 25% is a high number. Since the rules changed, including that delinking of the vote and the redemption, we have had a plummeting of failure rate between 2015 and the present. That 25% is down to 4%. So 96% of SPACs in 2015 have closed. So sponsors have lost money only 4% of the time. And for the past 2 years, it's down to 0%. So the odds are against you. Just, the failure rate has decreased substantially. Yeah. So that's much less of a risk today. But
yeah, I think that makes sense to me. Like, if I get paid to go do a deal and I lose $5 million if I don't do a deal, all of a sudden, towards the end of the timeline, that's exactly. A lot of deals, every deal on my street looks pretty good.
That's exactly right. But there is another restriction, by the way, along those lines, which is that there are two restrictions. Just keep them in mind with a SPAC. Number one is you can't actually know the deal before you do the SPAC. Yeah. So back to Kathy. Kathy, you can't find a company and say, oh, that's a good company. Let's do a deal over here. And then I'm going to raise a SPAC to buy this company. Yeah. It truly has to be a blind pool. You have to raise the capital without knowing what company you're
That's where the industry expertise becomes valuable. Like, I don't know what healthcare deal I'll do, but you and I will figure out something because we really know the space.
And you're in the market and you're talking to people and you know CEOs and you know bankers, etc. That's exactly right. So V&D will figure out a deal. And by the way, we can identify companies that we want to buy. We just can't go to them and negotiate a deal. So we can say, hey, that's a good deal. That's a good deal. We come together, we come up with a list. In fact, part of our SPAC in the box methodology is that we do identify, we call them our T13. We identify 13 companies. But we don't talk to them, but we do research on them. We rank them. And then one of the things we do in our methodology, because 24 months is not a lot of time, we go to our top 3 in the first 3 months, then the next 3 in the next 3 months, up to 6 months. So it's much more targeted, much more focused. Exactly right. And the reason it's T13, not T12, because after 12 months, we've gone to 12, is that we sort of have a 13th company that we feel comfortable that we know that the sellers would likely sell to us for some particular reason. So it's sort of a back pocket, thinking about it. But anyway, the issue that you raised is a very good point. So one concern for the sponsor, so we're a little bit worried we could lose our money, but we're not that worried because failure rate is low and we think we're pretty good. The other issue though is that the investors could take their money back. And that's a very real issue. And so even though we say to the seller or the person who is going to combine with us, we say, hey, we have $100 million. We actually don't have $100 million. There's $100 million sitting in a trust account, which belongs to the investors. So what we need is we need a backstop, to your point. We need some insurance policy that ensures that if those investors who have $100 million in our SPAC decide they want to take their money back, that we're going to replace it. The good news there is, remember those statistics I gave you about the huge demand for public companies, is that there are a lot of people out there who actually are looking for a product. So if we find a good company, then it's very likely that we will have institutional investors, the Fidelities, the Wellingtons, the Vanguards, et cetera, who will say, you know something, I love this company. I want to invest in this company. And so we will invest in what's called a PIPE. So for Kathy, for everyone else, you'll know what a PIPE is, but Kathy, a PIPE stands for, it's not something you smoke. It stands for a private investment in a public entity, a PIPE. And a private investment in a public entity is basically a private placement where we go to a select small number of institutional investors and ask them to invest in the stock of our publicly traded company, which is going to be merged with the company that we've decided to merge with, and say to them, once that deal is done, you're going to be a shareholder in this great healthcare company. And so we have investors who effectively will take the shares that those short-term hedge fund investors may or may not want to stay in. So maybe they stay in, maybe they don't. But here's the deal. Most hedge fund investors actually have very little interest in long-term fundamentals. Yeah. They're financial engineers. So actually, a PIPE is very important. And 75% of SPACs over the past 2 or 3 years have had PIPEs. Because what you're trying to do is you're trying to trade out those short-term hedge fund investors for longer-term fundamental investors. To know where
someone like Fidelity or someone like that
precisely
would like to stay with the company.
That's exactly right. That's exactly right. And so we at Navigation, we sponsor SPACs. So we will invest that $5 million in others. If you came to us and said, we want to do a SPAC in the healthcare space, we look at it, we determine if you meet certain criteria.
So you provide financing for sponsors that are maybe highly talented, but don't have $5 million.
Precisely. And don't necessarily, they may have the 5 million. So we're working with a team now which has the money, but they want us because we know the SPAC process. So they're like, we know our space and we know how to find a company and we know how to run the company once we buy it. But what we don't know is this whole SPAC process. And you know, the SPAC process
in the box is going to save me.
It's going to save me a lot of money, a lot of time, and it's going to be likely to give them a better outcome. Yeah. So it's not just money. We call it cash plus or capital plus. Yeah. So that's one thing we do. The second thing we do is if someone else, let's say you decided you were going to do it, you were going to spend your own money and you're going to sponsor an IPO, and you came and you said, hey, here's what I'm going to do. We look at your thesis, we look at your strategy, and we say, you know something, that's a good space. We'll invest in the IPO. And that's a good investment for us because we can get our money back, right? Yeah. And hopefully we can negotiate a deal with you where we say to you, hey, we can add a little bit more value, so maybe you can give us a special deal.
Yeah. Right? Well, you might invest in the IPO and also help with some of the financing as a sponsor.
Precisely. And then the third thing we do is we invest in that PIPE, that backstop. At the time of the business combination, when the hedge funds are leaving, we want to participate in the transition to the traditional fundamental long-term market. So those are the 3 strategies that we employ. And
I want to get to people, we're starting to answer the questions today, but 2 quick things to cover. It's pretty lucrative for the sponsors, I believe.
So
how do you and I make money if we do all this work?
Right. So that's a great question. And I'm sure people are thinking, well, why would you sponsor? Why would you invest $5 million? You could lose it. Whereas the investor doesn't have any, real chance of losing it if they decide to take their money back. And we could lose the 100 million. So why is this a good deal for the sponsor? Here's why it's a good deal for the sponsor. It's a good deal for the sponsor because in return for that $5 million investment, the sponsor receives 25% of the value of the proceeds raised in the IPO. So back to Kathy. Kathy, we just raised $100 million in the IPO. We wrote a check for $5 million, but we're going to receive in return $25 million in stock. So 100 million in the IPO plus the 25 million, so 125 million. And or 25 million of stock doesn't go into that trust account, right?
Yeah. But it's in that publicly traded.
But it's publicly traded, and we are subject to, Kathy, something known as a lockup. And that lockup is a restriction on our ability to sell that stock for a certain period of time. So the investors in the IPO can sell their shares at any time. We cannot. We must hold on to our $25 million worth of stock for the entire period until we find a company. And then after we find that company, for an additional 1 year period. So 1 year post the business combination.
Yeah, so you and I as sponsors, we're very incented to do a good deal.
A good deal, so that a year after the deal, our stock price is up and the value of our 25 million is more than 25 million.
Right,
yeah.
Right.
So that's the first thing we receive, but there's more. Wait, there's more. The second thing we receive is for our $5 million investment, we also receive securities valued at $5 million, typically warrants. So we will typically get $5 million worth of warrants. Now they could be worth less or they could be worth more, but we'll get 5 million of warrants. So from our perspective, V&D, we're like, we've just written a check for $5 million. It's subject to losing it all if we don't find a good deal. It's also subject to us not having the 100 million that we just raised, but hopefully we can have a backstop there. And in return for taking that risk, we've received $25 million worth of stock plus 5 million worth of other securities, $30 million. So at the closing of the IPO, we write a check for 5 million and we receive $30 million worth of securities.
Yeah.
That's
now,
a 6x return.
But it's a pretty good multiple.
It's a phenomenal multiple. And that's one of the reasons that we like that space. No, that 6x is subject to being 5 or 4 or 3 or 2 or 1.
Or 10. I mean, Draftkings.
But it could be higher. That's exactly right. So, and that's a risk we're willing to take. And so empirically, investors in at-risk capital or sponsor capital have had since 2015, just under a 7x return, almost a 7x return on their at-risk capital. And that includes deals that didn't do well, deals that failed, and deals that have gone up. Yeah. So empirically, a 7x return, there are very few investments out there where you can sort of on a consistent basis generate 7x returns. So we like that a lot. And it's in a liquid security that we can sell. We're locked up for a year, but we've done private equity. In private equity, we're locked up for 10 years.
Of that, right?
So a year lockup post-business combination is like a dream come true compared to a 10-year lockup in a private equity fund. So we actually like the risk-return trade-off there.
Yeah, and then the last question is, if you're running a family office, or I mean, let's say like a $20 million net worth family, how do they access this? Where do they plug in? How do they get involved? Are you raising money? Can they call Goldman or someone on Wall Street? How do they get access to this?
Yeah, so if I were in a family office or high net worth individual, I would speak to my broker and I would say, how can I invest in SPAC IPOs? All right, and how can I get in them? And could you give me access? And you probably can, and they should be able to give them. And I would look at them and I would do it. I actually think it's a pretty good strategy.
And you want high quality, but also with the optionality, I mean, they're all okay.
It's a good deal. And I have several good friends who have set up funds that just invest in SPAC IPOs. So you could do it through a fund like ours or others, or you could go directly through your investment bank. The sponsor capital is a little bit more hit or miss. That's private deals, and getting access to those deals are much harder. You're lucky if you have a network of people and people come to you. I'm sure family offices or high net worth may have had people saying, I'm thinking of doing a SPAC. Could you invest? And so
that's more like my business and your old business where it's, you have to have the right deal flow, the right connections to know.
And that's one of the reasons we set up our fund. That's what we do. We invest in these deals, right? And so if you want access, obviously you could invest in our firm. I'm not recommending that. I can't solicit capital, but in theory, that's what we do. And not in theory, in practice, that's what we do. Yeah. And if you want access to pipes, again, those are more off market, a little bit more difficult to do. We're looking at a pipe right now in a very good brand, very good company. literally 10 companies are looking at it.
Yeah.
So we have access, because we have the relationships with the investment bank, to these pipes. So relatively easy to invest in SPAC IPOs if you got a good investment banker. Harder to do sponsor capital, harder to do pipes. We do all three, and we think we have great access and better access than most.
Right. So for navigation, you're sort of building a portfolio of all three strategies. Correct. And multiple positions in each.
That is exactly right.
One of the questions is, do you have any visibility to what the minimum is on a SPAC IPO?
Sure. So there is no, I don't believe there's a formal minimum, but here, let me just give you
your banker won't take the call if it's below someone.
So in the first 20, 30 years of SPACs, the average SPAC size was around $100 million. So some were less, 50 million, some were more, 200 million, et cetera. In the past 5 years, since 2015, the average SPAC size has doubled from 100 million to 200 million. And this year, 2020, I didn't give you these statistics, but let me just give you these statistics so you get them. In 2019, which was a record year for SPAC IPOs, there were just under 60 SPACs that did IPOs in all of 2019. And those 60 SPACs raised approximately $15 billion, just under $15 billion. This year, in 2020, double the number of SPACs have done IPOs. So now over 120 SPACs have had IPOs in 2020, the year of COVID, which is shocking. And they have not raised double the money, they've raised 4 times the amount of money.
Wow.
So they have gone up to 400 million. So the average in 20.
From my point of view, the incentives for the sponsor, I think, are to do bigger deals.
Correct.
It's the same amount of work, and I get 25%.
And this year we've had a record. So the largest SPAC prior to this year was $1 billion SPAC. The largest SPAC, which was Bill Ackman, who has Pershing Square out of New York, he did a $4 billion SPAC. And so the minimum really is probably 50 million. And realistically, the minimum should be 100 million today, because institutional investors don't like a small $100 million company or a $50 million company. So I would think in my mind of a minimum of 100 million. And I've given you the averages.
Yeah. Okay, and then there's a question about healthcare. That there's 2 healthcare deals that are going on right now that I want your impression of. So HIMSS, I think Oaktree did a sponsored SPAC, and they just de-SPAC'd with a company called HIMSS, which is a retail online direct-to-consumer healthcare company. It's a $200 million, a little over $200 million deal. I think it's a 1.9 or $2 billion valuation.
That's correct.
Has not closed yet, but it's in that interim where they've announced it, but it's not closed, I think.
That's correct. And have you heard of Cloverhealth? Yeah,
and Clover is Social Capital is sponsoring Clover. They're at least I follow them. There's a really well-known.
So let me just give you a quick overview, since someone asked about healthcare. So Cloverhealth has this Medicare Advantage plans, which have all the essentials like hospital coverage, doctor visits, drug coverage, Part D, but they have no cost extras, like they have vision, dental, and hearing coverage, etc.
And they're much more friendly. Like they're just it's better designed. It's what you design with an insurance company today versus what you might have done 40 years ago when many of them got started.
That's exactly right. It's a fast-growing company. They expect in 2021 to have revenues of $880 million. And they expect to grow to 2023 to 1.7 billion in revenues. So Social Capital, which is a firm started by a gentleman named Chamath Palihapitiya, who is one of the most active investors in SPACs. They have a SPAC called IPOC. That's their ticker, IPOC. And the reason it's IPOC is Chamath has done something very smart. He's gotten the ticker IPO, and all of his SPACs, and he's a serial SPAC investor like us. He has IPO A, IPO B, IPO C, which is this SPAC, which is merging with Clover. And then he's reserved the tickers IPO D, IPO E, all the way to Z. So he plans to do at least 26 SPACs. So here's how that deal works in the Cloverhealth deal. He has $828 million in his cash in trust, okay? He is doing a PIPE, a private investment, a public entity, for $400 million, okay? And then there are affiliates of his, including himself, who are investing an additional 155 million.
Yeah, and I know Fidelity's in there. I mean, there's like all the classic.
They've got some very, very good folks into this company. And so that gives Cloverhealth a pro forma enterprise value of $3.7 billion. So this 828 million pipe is doing a deal with Clover, SPAC IPOC is doing a $3.7 billion deal, which works out to 4.2 times revenues of 2021 estimated of 880 million.
A little over 4 times future 12-month revenue.
Future 12-month revenues. That's exactly right. And what has happened is there has been a very significant increase in the number of Clover has been backed by venture capital firms. So what's been driving a lot of these SPAC deals is that there are a large number. Back in 1996, when there were 8,000 publicly traded companies, there were only about 2,000 venture capital backed firms. Today, there are 10,000.
Yeah.
And of those, probably 2,000 to 3,000 are either unicorns or mini unicorns. Okay. So Clover don't view themselves as a healthcare company. They view themselves as a technology company whose software allows them to improve outcomes and lower costs.
Well, the multiples are better if you call yourself a tech company.
Precisely. And then the other driver on the other side of things is actually the private equity industry. So back in 1996, there were fewer than 2,000 private equity portfolio companies in the United States. Now that number has quadrupled to over 8,000. So there's been a flip. So now you have 8,000 private equity backed companies, many of which, in fact, most of which are probably highly levered, and especially with COVID, even more highly levered now because EBITDA has fallen. So as a multiple, the multiples are much higher. And these companies need to exit. And how can they exit? They can do an IPO or they can sell to someone else. Now, selling is trickier because you won't necessarily get the valuations. And in a COVID market, there are not many people buying. But who is buying and who has a lot of money now are SPACs.
Yeah.
And so SPACs provide a huge advantage, and this is important to understand for your audience, over a traditional IPO. So an IPO, as a general principle, will be better than selling to a private company because public companies trade at higher multiples than private companies.
Yeah.
Because of the liquidity premium. Okay.
Right.
All else being equal. So if you can take a company public, if you can deal with the headaches of being a public company, all else being equal, it's probably a good idea. Now, you could do an IPO, but the problem with a traditional IPO is, number one, it takes a long time. It could take a year or two. Number two, it's very expensive. It could cost you $5, $10, $15, $20 million to do an IPO. So a SPAC is shorter time and much cheaper for the seller.
I mean, you're not going to do an IPO to raise $100 million.
Correct. And then the last thing, and this is very important to understand as a difference between a traditional IPO and a SPAC, which a lot of people don't know, which is that in a traditional IPO, the SEC prohibits you from presenting to potential investors your financial projections beyond a year, right? That's a restriction. You can't say, here's our 5-year plan. You can say, here's guidance over up to a year, but you can't say, here's our 5-year projections.
Particularly for the two companies we've mentioned, Hims and Clover.
Very important.
Their longer future.
It's critical to be able to do that. So here you have a unique mechanism which allows you to provide financial projections going out 2, 3, 4, 5 years. In fact, not only can you do it in a SPAC, you have to do it. You're obliged to do it for various reasons, which I won't get into. And so that fact has made, I believe, has been, so the demand from fundamental investors for publicly traded companies, the push factor from private equity firms, which have 8,000 highly levered portfolio companies, the push factor from venture capital firms, which have invested at these higher and higher rounds and which need to exit, has led to, they've all come together in this confluence.
And the financial incentives that are well developed now after 25 years and well designed. And so I'm a believer. The reason I wanted you to do this, and I'm trying to learn myself, is I think health is so much disruption and change in health that this is going to be a really interesting market. I mean, we have 2 multi-billion-dollar SPACs right now going on.
And there are going to be many more. There are going to be many more in healthcare sector.
Just in the last couple of minutes, what's your website? If people want to learn more about Navigation Partners, how do they find it? I know you're not not actively, can't be publicly raising money, but you do have a website they can go to, is that right?
Correct. So if anyone wants to learn more about Navigation Capital, our website is navigationcapital.com. So NAVIGATIONCAPITAL.com. And if anyone wants to reach out to me, I'm glad to speak to folks. My email is dpanton. So my first initial, David, and then my last name, P-A-N as in Nancy, T-O-N as in Nancy, dpanton at navigationcapital.com. Glad to talk to folks, especially people who are interested in doing a SPAC or are interested in learning more about the SPAC space.
Yeah, excellent. Well, thanks for doing this. It's been really fun. I learned a little bit. I learned a lot when we started talking about a week ago. It's an exciting space, and I think healthcare is going to be a big piece of it. So, David, thanks for doing this. Any final things you want to touch on?
No, I just encourage everyone, if you want to learn more, to reach out, and you know, I'll give you one other little tidbit. If you want to learn more about what's happening in SPAC land, there are a couple of sites. There is one called SPAC Insider, and then there's also, I don't work for them, but I really like pitchbook.com. I don't know if you use.
Yeah, I'm on PitchBook. PitchBook is incredible.
It's very good resource.
It's expensive just to get on as an individual or family office, but they have a ton of great information.
It is, but the good news about that is that you get a free newsletter. You can sign up for their daily newsletter.
Oh, I didn't realize that. Just not even a subscriber.
Without being a subscriber, you can sign up for free, which is what I did years ago. Our firm just bought a subscription to PitchBook, but before that, I just used the newsletter because it's a very good daily digest of what's happening in the markets. So
yeah,
little tidbit of information.
I mean, like a lot of things in life, where like people need to learn about this space, but once they learn it and really get comfortable, there's incredible opportunity as an investor, as a sponsor, doing a pipe, just sort of even buying them as they de-SPAC. It's kind of interesting too.
Yep, no, that's exactly right.
All right. Thanks, David. Really appreciate you walking through it with us.